You know, the days of sitting on the beach and enjoying your retirement might not be that dream. You ever think about continuing to work in retirement? A lot of you might say no, but the fact of the matter is we're walking into a new economy, and it's called the gig economy. Are you familiar with that term? Probably not, but a lot of people will need to watch this show to figure it out. Welcome, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's sitting right over there, and we work for a company that is called Pure Financial Advisors. We're extremely excited today because we're bringing in some new information for you, the gig economy. Let me show you this real quickly. When you look at people in retirement, 49% of individuals in retirement are working some sort of part-time job to fund their overall retirement. That is a huge stat. And if you're approaching retirement, you need to figure out, are you going to start a business? How are you going to structure that business? And how is the tax code going to help you with that business? That's today's Financial Focus. Take a look at these stats. Why are people working part-time in retirement? Well, I'll tell you why. Is that almost 70% of people have less than $100,000 saved. Less than $100,000. 33% of individuals that are approaching retirement have over $100,000. 70% have less. With $100,000 saved, that will provide you maybe $4,000 of income per year, not per month, per year. So that's why a lot of individuals are looking for this gig economy, looking for a side hustle, if you will, to supplement their overall income. Let's bring in the big man right now to break everything down to help us out. Big Al Clopine.
Retiring in the gig economy. So that's what we're going to talk about today, working through retirement. And this is new for a lot of people because maybe you've worked in a career for 30 years or 40 years, and how do you even get started? So we'll start there. In some cases, you want to take a look at what entity that you want, whether it's a sole proprietorship or a corporation. We want to get into retirement plans, self-employed retirement plans, because when you make a certain amount of money, you want to shelter that, you want to add to your retirement accounts. And then finally, the new Tax Act. So this changed a whole bunch of things for self-employed taxpayers. So that's what we're going to get into today, Joe.
I mean, you look at a few different things, right? We're living a heck of a lot longer. People don't necessarily have the savings that they need. Right. And then now what do they need to do is they need to supplement their overall retirement with additional income.
Yeah.
And so it's like, well, how do you get started with all of this? I think one of the best things that you can potentially do is just start thinking about things now. It's like, all right, well, here, I have a passion for this, or I'm really good at this, or I have a very specific skill set in a certain area, and then start researching it. You know, hit the web, right? You take a look and say, well, what are other people doing? There's a lot of resources out there that you can do all sorts of different talents, that you have different talents, and you can create cash flow from that, and a lot of you will need to do it. You know, there's some popular jobs right now. You look at Uber, Al, a lot of retirees are driving Ubers and Lyfts.
Well, that's exactly right, Joe. And I think in a lot of cases, you kind of start with your current profession. Like if you're an accountant, maybe you can do tax preparation or bookkeeping or whatever it may be. Now, some of you are going to say, I don't want to do my profession. I'm sick of it. So then it's like, okay, take an assessment of your skills, what you may want to do, and then get some training, because that's what it's all about. And in some cases, maybe you don't even know what's possible. There's a lot of resources like sidehustle.com where there's all kinds of ways that you can make money on the side.
So now that you've thought of this, it's like, okay, I want to build a business. So what are the next steps? Is that you want to make sure that you separate your business from your personal life. So I think one of the first things is probably just set up a standard checking account and get the right licenses and registrations.
Well, I think so, Joe, because in the case of the IRS, they really don't like it when you commingle things. So when you got your personal and business together, they get a little bit upset on an audit. So do some separation. Think about maybe what kind of entity you want, whether it's a partnership or whether it's a sole proprietorship. Maybe that's fine. Maybe an S-corporation. There's pros and cons to each of those. Do make sure that, Joe, you've got a good accounting, because how many times do we see new business owners, what did you make, what are your expenses? I have no idea.
Right, and everything is, hey, I made $50,000, but then they had $60,000 of expenses. It's like, no, you lost $10,000. Right. That business is not doing very well. So you want to make sure that you understand, hey, we got revenues and you got expenses. After that, that's your net profit. Now, where you start making money, you might want to start thinking about the entity. What type of entity should you use in regards to your overall business? You can do a sole proprietorship. You can do an LLC, maybe a partnership with just you and an individual. And then you want to make sure, all right, well, if it gets a little bit bigger, then you have an S-corp. All right. So, Al, what would be the difference of an individual saying I'm going to be a sole proprietor versus having a full S-corp?
Yeah, it's a great question and a common question we get. I'd say most people start as sole proprietorships, and that's actually what you are if you don't do anything. So you start as a sole proprietorship. That simply means all your income, all your expenses get recorded on your personal return. Now then a lot of folks, when they make a certain level of money, Joe, and this is in order to save taxes and to get some legal protection, maybe they go to an S corporation. And in the case of an S corporation, if you have employees or you have a partner, you may get some insulation, wrongful termination, you get some legal insulation there. But most importantly, most people go S corporation because they want to try to save on self-employment tax, because virtually any other kind of flow-through entity, it's earned income, meaning that you have to pay self-employment tax on that earnings.
Yeah, I think people get confused. Is that, all right, well, if I'm a sole proprietor and then all of a sudden I set up this S-corp, it's still a flow-through entity. It's still going to go onto your 1040. And so you're going to, everything just shows up there. So there's some tax savings that we want to get into if you are a small business owner. You have a lot more opportunity to save money and shelter money from taxes, especially with the new tax code or the tax reform that just came out. So you don't want to miss that. So when we get back from the break, what we want to do is break down a couple of different retirement plans that you have availability to if you're a self-employed individual. Then Al is going to break down the new tax law and say, all right, well, you got this 20% deduction and then you got QBI. What does all of this stuff mean and how does it apply? Because it could have a dramatic effect on your overall retirement. Also, go to yourmoneyyourwealth.com. We have a tax checklist available for you. So you can basically go to our website, and it's a great document that you can just check things off to make sure that you're in line in saving money on tax. Don't go anywhere. We'll be right back. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al, hanging out here talking about the gig economy. What the heck is a gig? You ever hear like a band say, hey, we got a gig? Now this whole thing is getting crazy. It's a part-time job. So everyone needs a part-time job, so the whole economy is going gig. Al, can you believe it? What the hell is going on?
It's almost a new word.
It is a new word. And we're explaining it today on Your Money, Your Wealth. Before we get into more gig talk, let's get to the true-false question.
Profits that pass through from an S corporation are subject only to income taxes and not self-employment taxes. And that's actually a true statement, but there's a little bit to unpack here. So an S corporation, so its profits flow through to your personal return. So you pay income taxes on the S corporation's profit. You're also supposed to pay yourself a salary. So when you pay yourself a salary, you have Social Security withheld and your employer matches that. But when you have, yet again, additional profits from the S corporation, there is no self-employment tax, which is related to Social Security. So therein lies one of the reasons why people switch to S corporations when they have a small business.
Yeah, Al, but there is fraud when it comes to that too.
Well, because they go overboard.
Right? They say, I'm going to pay myself a $10,000 salary and I have a $500,000 profit and I avoid all that self-employment tax.
Correct. So you have to pay yourself a reasonable salary, Joe. I mean, that's really what it comes down to.
Looking at having a large income, well, being self-employed, you have benefits that people that are working for the man or the woman do not. And what we're talking about is some retirement plans. There's a lot of different retirement plans that you can contribute to if you're self-employed. So I'm a sole proprietor, I have my own business, and I'm making some profits. There's different things and different levels of plans that you can choose. Al, the SEP IRA, I would say, is probably one of the most common self-employed pension plan or retirement plan, but I don't know if that's the best. But why do you think the SEP is more common than most?
Well, I agree with you, Joe, and the reason it is because it's probably the most simple. And you can do it after the fact, and what I mean by that is all these other plans you've got to set up within your same calendar year of your business. A SEP IRA you can set up in the following year before you file your tax return, and that's often when people think about this. They have a certain amount of profit, and I can set up a retirement plan and take a tax deduction. So I would say that's why that's most common.
So these other plans you need to set up prior to the end of the calendar year. Simple IRA, well, it's simple to set up as well, right? But they have different contribution limits. Everyone's pretty much familiar with the 401k, but if I'm self-employed, I can set up what is called a solo 401k or an individual 401k. So I have the same benefits as the big 401k plan providers, but there's added benefits because now I'm a solo practitioner. I can potentially put a lot more money in. And then here's the big daddy of them all. It's the defined benefit plan. This is where if you're making significant amount of money, you can shelter hundreds of thousands of dollars pre-tax into these types of plans, all for your retirement. So it really depends on the level of income, the level of complexity that you're looking to do. And I don't know, Al, why they have so many plans. Well, I mean, let's just make this a little bit more simple. They call it a simple IRA, but it's far from simple.
It's not really that simple, Joe, and you are right. And speaking of a defined benefit plan, for example, this is the plan that you set up when you make a lot of money. You're generally older. It's based upon a future benefit, not a contribution limit. So in many cases, people are able to get a couple $100,000 into it. That's a great tax deduction, but it's expensive. It's expensive to set up, it's expensive to administer each year, and it's expensive to terminate.
So when you look at just comparing these plans, is that you have a SEP IRA, simple IRA, 401k, defined benefit plan, but there's also money purchase plans, there's profit sharing plans, and even a couple of more. But this is for someone that is 50 years of age or older, and here's the max contribution limits. So on a SEP IRA, which Al talked about, you file your tax return next year, and you say, wow, look at these profits. I want to shelter some of this from tax. You can set up a SEP and contribute 20 to 25% of that compensation. So it's a good shelter. A simple IRA, you have to establish before the end of the year. There's some deadlines here in October, actually. But you got $15,500. That's the maximum allowable that you can contribute. Then you got $24,500. Right? So that's the 401k plan. So everyone's kind of familiar with those limitations. $18,500 plus the catch-up of $6,000. A defined benefit plan is calculated based on your age. So what they're doing is they're trying to front load this thing to give you a certain amount of income when you do decide to retire. But then here's what's unique about being self-employed. Now I'm self-employed. I'm the employee and the employer, right? So I can double dip a little bit. So actually your defined contribution plans are about $55,000 that you could shelter. If I'm looking at a simple plan, I want something a little bit easier, maybe up to $23,000, $24,000. The 401k plan, if I include a profit sharing plan on top of that, could be up to $61,000. And then a defined benefit plan could be up to several $100,000. So when you're looking at this, it's like, man, I'm self-employed. I can shelter a heck of a lot more money from taxes than if I'm just a regular employee, because then I'm just stuck to certain levels here. But I think where the real meat comes to play here, Al, is the new Tax and Jobs Act that just came into effect at the end of last year. For self-employed people, you really want to make sure that you understand how this QBI deduction works.
Yeah, it's called qualified business income. And this is what happened. So in December of last year, the new Tax Act created a new tax deduction for small businesses. Small business being defined as a flow-through, a business where the profits flow through to your individual return. You can deduct up to 20% of your profits. So if you gross $150,000 in terms of income, you have $50,000 of expenses, you end up with $100,000 of profit. 20% of that that's $20,000. That's the amount of potential deduction, this QBI deduction. So what that means is you'd only pay taxes on about $80,000. So to look at a quick example, Joe, if you've got that $100,000 business, you may be only paying tax on $80,000.
Yeah, you take a look, you have $100,000 of net profits from your business. Well, here, this 20% deduction, that's the QBI, qualified business income deduction. Well, I get 20% out the top here. So I'm going to be taxed on 80% or $80,000. Well, guess what? Put another kicker on top of this. We just went through some retirement plans. Now you add a solo 401k to this, and then you can continue to shelter more and more dollars. So this is going to be huge. Let's say for all of you real estate owners out there that have rental real estate, there's another huge thing. You got rental property that's bringing in $50,000. Guess what? You get this QBI deduction on rental property. So right here, 20% of 50 grand, I'm only taxed now on 40. So if I'm looking at small business owner, real estate owners, this QBI or the 199 cap A tax deduction is absolutely a monster, but it's so dang complicated, Al.
Well, it is complicated, Joe, and really to try to simplify it the best we can, there's a couple things you need to be aware of. And so the 20% QBI deduction, it has to be it's going to be the lesser of, there's another limitation, lesser of that or 20% of your taxable income, whichever is lower. So you got that limitation, and then probably even more importantly, if you're single and your taxable income's more than about $157,000, married $315,000, it gets much more complicated. And then there's all kinds of other limitations, whether you're service business or non-service business, how much you pay in salaries, what's your cost basis of the equipment that you depreciate. Joe, at that point, it's anything but simple.
Right. So I think the point of this is that if you're a small business owner, you're making less than $157,000 as a single person or $315,000 as a married couple, there's a lot of things that you could potentially do. But all of a sudden you get into these phase outs, we've seen all of a sudden tax spike up to about 40-50%. So you want to make sure that you understand this. That's why we created this tax checklist. Go to yourmoneyyourwealth.com, just click on the special offer, and you can get in the weeds all day long with this stuff. We got to take another break. We're going to get back. We're going to flip the show to you. We're going to ask the experts. We're going to wrap this thing up. It's going to be awesome. Don't go anywhere. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson and Big Al. We're talking about the gig economy. And what the heck's a gig? You know, remember, did you get a new gig? That's a job, maybe a part-time job. So this old phrase is coming to the new economy. So we're trying to play on words. Most people are confused. Let's go to the true-false question.
Professionals in the fields of health, law, accounting, brokerage, and consulting services can never benefit from the tax reform business deduction. And
that's a mouthful, Al.
It is. It's hard to say, right?
There's a lot there.
But it's false. And a lot of people think it's actually true. And the reason they think it's true is because of this. When you look at this new 20% deduction, we just talked about it last segment, is you get to take your net profits, 20% of that could be a deduction off of those profits, and you pay taxes on only 80% of your net income. Well, then there's this whole thing about if you're a service business in one of these fields, you don't qualify. However, when your income is low enough, when you're single and your taxable income is below about $157,000, you still get this full 20% deduction. If you're married, it's $315,000. So it's false, Joe, because some people can qualify for it, some people will not.
You know, we're talking about the Tax and Jobs Act, and there's a few more things that you want to be aware of. Tax rates are lower. We have this QBI or qualified business income deduction. That's the 20%. There's a few other things, Al, that people probably want to be aware of if they do have a small business in regards to the new tax law.
Well, that's exactly right, Joe. And I guess right off the bat, let's kind of focus a little bit on this higher equipment deductions. So that is, it's also known as the 179 deduction. You can buy a piece of equipment, you can write it off dollar for dollar. Let's say you got a couple $100,000 of profit in your business and you need to buy equipment for $200,000. You can buy that equipment on the last day of the year and fully deduct it. So with this new Tax Reform Act, they told us that you could deduct $1 million. That's a $1 million. $1 million of equipment. So if you got $1 million of profit and you need to buy a bunch of equipment, you can buy that equipment on the last day of the year and take that deduction. That's about double what it was last year. And just a few years ago, it was a couple $100,000, and before that, it was $100,000. So this is a huge benefit. And then something to be aware of is this entertainment expense.
What, no more Super Bowl tickets?
No
more,
no more Super Bowl tickets.
Cocktail parties.
You can go, you just can't write it off, right? That's really what it comes down to.
So all these big firms, right, if you got sports tickets and things like that, for right now, a lot of these firms are not necessarily buying them because you can't write them off anymore. So, all right, hey, let's switch gears a little bit. Let's go to Ask the Experts. We're going to bring in two experts into the studio right now to answer your email questions.
Okay, first one is from Leslie in Carlsbad. I manage 4 rental properties that my husband and I own. The properties net about $80,000 each year. Can we start an LLC to benefit from the new tax laws? And Leslie, that's a great question. So let me sort of explain. An LLC is an entity that you can set up. You can actually put your properties in the LLC, and so now the LLC owns them. But what happens is the income and expenses, just as they always were, are in the LLC. They flow through back to you, back to your tax return. So the tax impact of an LLC is actually zero. There's no impact because the same tax treatment that you had without the LLC is the same as when you do have the LLC. And the reason, Joe, people get LLCs generally is for limiting liability.
Yeah, it's just basically to protect themselves. So if someone falls, breaks their leg, and then they sue you, right, it would only be up to that entity in a sense.
Correct.
Where if I just held it in my own name, well, then I could be subject to lawsuits, and then they could take other assets. But if you put the shell of a limited liability company within the real estate, that just shelters it, that protects it. But there's added expenses and complications and things like that. Let's go to the next question. What do we got?
All right, this is Bob, Chula Vista. For the past decade, I've had a sole proprietorship business that nets about $75,000 per year. Are there tax benefits to turning it into an LLC? That's a similar question to what we just had. And the answer is actually the same, whether it's a rental property or business. Because a lot of people think they can set up a partnership or an LLC or an S-corporation and save a bunch of taxes. Let's start with an LLC. If you're the sole owner of that LLC, you put your business in the LLC, and it's a disregarded entity, so it actually still shows up on your personal return as if it weren't even there. So there is no tax benefit there per se. Now, you do get some liability protection, as Joe just mentioned. Maybe a smarter thing, though, is to think about an S-corporation. Because an S-corporation, you put your business in an S-corporation, it still has $75,000 of profit, but now you have the ability to split that profit between salary and business profit. The salary, you got to pay Social Security taxes on, and so does you being the employer, about 15%. But the business profits, there's no Social Security on that. So you have the ability to kind of decide how much salary versus profits, but you can't go too far because, Joe, the IRS wants you to have a reasonable salary for your efforts.
Yeah, and I think with an S-corp is really an LLC. It's an LLC subchapter S, so then it gets even more confusing, right?
It is very confusing. But the S-corporation you can save taxes because of what I just mentioned. You can save some self-employment taxes potentially, but you don't want to go too far because the IRS doesn't like it when you pay yourself too low of a salary.
So what the heck did we learn today? Well, what we learned is that there's a lot of people that are going into retirement. What the statistics said is that by Betterment, almost half of people in their retirement years are still looking to get more employment, right? Maybe starting a business and getting that extra cash flow to help supplement their overall retirement. So then we got into, all right, well, if you need a job, how do you go about set this thing up, right? What do you do? What are the steps that you need to take? What type of entities should you establish? Should you stay a sole prop? Should you go LLC, subchapter S? How about a C-corp? And then we looked at, all right, now you're really profitable. How do you shelter some of this stuff from taxes? So we looked at retirement accounts. We looked at SEPs, Simples, 401ks, profit sharing plans, the whole gamut in regards to your contribution, the employee and the employer, and the benefits and the pros and cons of all of that. And then we got into this crazy world of QBI, the qualified business income deduction, and how that affects small businesses. Now, this is a key component of the tax law. When it looks at small businesses, it's really trying to help save money in tax, bring better opportunities so more people will establish businesses, and then hopefully get employees and so on and so forth. So hopefully you got a lot out of the show. I know I did. Big Al basically educated the world on QBI. If you don't understand it, guess what? We have something else for you. ShamWows. No, I'm kidding. We have the tax checklist. The tax checklist. You can go to yourmoneyyourwealth.com, click on special offer. We got a tax checklist that breaks everything down so you can have that form right in your hands and check things off to save money in tax. That's it for us today. Hopefully you enjoyed it as much as we did. For Big Al Clopine, I'm Joe Anderson. You just watched another phenomenal episode of Your Money, Your Wealth. Have a wonderful weekend, everyone.